Supermicro jumped 5.8%. Its Moat scores 42 out of 100. Fragile. A 42-point Moat score flags fragile competitive advantage despite the rally. Supermicro's unique thermal integration platform locks in hyperscale customers needing extreme cooling for AI workloads. Our teardown reveals how this niche strength could reshape margins and drive long-term engineering leverage. What operating evidence matters most for Supermicro Computer Incorporated? The durable case for Supermicro rests on its role as the primary physical integrator for the most demanding thermal environments in the history of computing. And another question, what could weaken Supermicro Computer Inc.'s Moat durability? However, the bare challenge is now visible in the hardware telemetry, and it is devastating. Supermicro sits as a Tier 2 beneficiary in the AI supply chain, the server integration layer, currently in a peak phase. Verified institutional accumulation data is currently unavailable. Supermicro's ongoing financial filing delays block this transparency. Investors want a price in a massive hardware rebound. This surge pushes Supermicro's market cap, the total value of a company's outstanding shares, to $16 billion. The move rode a broader Nasdaq recovery. Competitors Dell and Hewlett-Packard Enterprise also climbed. Wall Street treats this as a relief rally. They bet the worst of the AI hardware correction is over. The market prices in stable high-density server demand. Hyperscalers continue their massive infrastructure build-out. However, this single-day jump masks a brutal reality. Supermicro underperformed the technology sector by a significant amount recently. The stock remains pinned below its 20-day moving average, the average closing price over 20 sessions of $27.93. It sits below its 50-day moving average of $32.93. Volume is 31% below its 20-day average. This reveals a lack of institutional conviction. Retail momentum is trying to spark a turnaround, but smart money is sitting on the sidelines. They are waiting for Supermicro to resolve its regulatory crisis. No major fund will buy this risk. The technical chart remains broken. This rally is noise, not a structural trend. Does the engineering actually justify what the market is pricing? The answer lies in the physics of the Blackwell NVL72, NVIDIA's liquid-cooled rack architecture connecting multiple GPUs. This platform demands high kilowatts of power per rack. This thermal limit completely breaks traditional air-cooled data centers. Supermicro relies on its proprietary DLC, direct liquid cooling, which circulates liquid directly over silicon. This setup requires a custom CDU, coolant distribution unit, the pump system regulating coolant flow rates. If a single CDU fails, the entire rack melts in seconds. Engineers must design complex leak detection systems. Supermicro uses proprietary backplane designs, physical interconnect structures routing power and data between servers. This architecture directly competes with Open Standard OCP, Open Compute Project, the open-source hardware designs for hyperscalers. While Supermicro's custom plumbing allows rapid deployment, it creates a closed ecosystem. Dell is closing this gap with factory-integrated liquid cooling. HPE is also scaling its thermal density solutions. Meanwhile, ODM, original design manufacturer, companies building hardware directly for other brands. Giants bypass integrators entirely. Meta and Amazon are buying direct. This structural shift is already showing up in the numbers. Supermicro's revenue plummeted sequentially from some billion in Q2 2026 to some billion in Q3 2026. This sequential decline proves their speed-to-market moat is rapidly evaporating. Gross margins sit at a razor-thin 9.9%. Operating margins, the percentage of revenue left after paying variable production costs, are only 6.1%. Supermicro has zero margin for error. The physical reality of server integration does not support a premium valuation. Structural margin compression remains the dominant risk. Quarterly financials showing modest revenue momentum for Supermicro. The dominant macro force squeezing Supermicro is the rapid normalization of the yield curve, the spread between long and short-term interest rates, which is transforming how hyperscalers finance their massive capital expenditure budgets and forcing a brutal rotation out of high-beta infrastructure names. with the Federal Reserve holding its benchmark rate steady at 3.63% and the yield spread normalizing to plus 0.37%. The era of cheap, speculative capital has officially ended. For a company operating with a beta, a measure of a stock's volatility relative to the broader market, of 1.94, this macroeconomic shift is highly volatile. While the broader market is enjoying a relief rally, institutional capital is in a clear distribution phase, the stage of the market cycle where large institutional investors quietly sell down their positions to retail buyers. Smart money is looking past the daily noise because prediction markets on Kalshire currently price the U.S. recession risk at 6.8%. For Supermicro, which relies on rapid debt issuance and revolving credit lines to purchase expensive components before assembly, a sustained 3.63% cost of capital acts as a persistent financial break. It increases their cost of carrying massive inventories at a time when sequential revenues are starting to contract. This monetary friction is compounded by a looming regulatory storm. The threat of a 50% tariff on Canadian imports, alongside stalled trade deals with India, signals a return of aggressive protectionist policies. For the server integration layer, the step in the supply chain where individual motherboards, power supplies, and cooling units are assembled into complete racks, tariffs are a direct tax on hardware margins. Supermicro's speed-to-market advantage relies on a seamless global flow of components. If trade barriers go up, the cost of importing specialized metal chassis or custom quick disconnect couplings, the leak-proof valves that connect liquid cooling tubes to hot silicon, will spike. This policy shift threatens to crush their gross margins, exposing the fragility of their business model. Beyond the trade borders, the geopolitical landscape is a high-stakes chess game where Supermicro is caught in the crossfire. The global AI supply chain is a highly concentrated pipeline. Capital flows from design firms to equipment makers, then to foundries, advanced packaging facilities, and finally to server integrators like Supermicro. However, this capital concentration is hitting a structural bottleneck. The threat of sudden export controls or supply chain disruptions in East Asia means that hardware integrators are constantly running the risk of component starvation. If a geopolitical choke point blocks the delivery of advanced packaging materials, Supermicro's massive assembly lines in San Jose will grind to a halt, leaving them with depreciating inventory they cannot ship. This physical vulnerability is colliding with a powerful social and political shift, the rising backlash against the environmental footprint of AI data centers. Local governments are increasingly restricting grid access due to the massive power demands of high-density server clusters. But as public policy shifts towards strict energy conservation, the political pressure to limit data center construction acts as a major demand bottleneck. Furthermore, the market is waking up to the reality of ODM direct sales, original design manufacturers who bypass integrators to sell directly to tech giants. Hyperscalers like Meta and Amazon are facing intense pressure to optimize their capital efficiency. To cut costs, they are bypassing middleman integrators entirely, dealing directly with Asian manufacturers. This structural disintermediation means Supermicro's short-term speed-to-market moat is rapidly evaporating. What looked like an infinite growth engine is running headfirst into the physical limits of the electrical grid and the cold economic reality of corporate cost-cutting. Supermicro reported earnings per share of $0.84, beating the Wall Street estimate of $0.63 by 32.3%, a solid beat that signals strong execution. Supermicro, server integration, is trading below its 20-day average. Management's headline: Supermicro's transformation into a total data center infrastructure provider is accelerating, said Charles Liang, founder, president, and CEO of Supermicro. The momentum breakdown for Supermicro, RSI sits at 31, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. The durable case for Supermicro rests on its role as the primary physical integrator for the most demanding thermal environments in the history of computing. At these power densities, air cooling is no longer a design choice. it is a physical impossibility. SMCI's modular building block architecture, a standardized system of interchangeable server components that allows for rapid customization, has given them a 6-month lead in deploying DLC, direct liquid cooling, which uses circulating fluid to pull heat directly from the silicon. By shipping fully integrated, liquid-cooled racks at scale, while Dell and HPE were still refining their coolant distribution manifolds, SMCI captured the first wave of hyperscale AI infrastructure spend. However, the bare challenge is now visible in the hardware telemetry, and it is devastating. The lab identifies a sequential revenue cliff that the promotional press releases have failed to mask. Net sales plummeted from $12.7 billion in Q2 2026 to a lower level in Q3 2026. Institutional conviction is fracturing, while UBS and Marshall Wace added to their positions according to their 13F filings. The quarterly SEC reports that disclose institutional holdings. Morgan Stanley trimmed its exposure by 32%. This exit by major funds, combined with the resignation of Ernst & Young as their auditor, signals that the governance risk is now inseparable from the engineering reality. The hardware is scaling, but the corporate structure is buckling under the weight of its own growth. The lab's answer is a hard no. We are currently witnessing the expansion of ODM direct sales, original design manufacturers like Foxconn and Quanta who build the hardware and sell directly to Meta and Amazon. These hyperscalers are increasingly bypassing integrators to capture the margin themselves. SMCI's 9.9% gross margin, the percentage of revenue remaining after direct production costs, is already razor-thin. If liquid cooling parity is reached by Dell and HPE, SMCI loses its only lever for pricing power. The PR narrative focuses on green computing and energy efficiency, but the 10Q risk factors, the detailed legal disclosures of business threats, reveal a company trapped between NVIDIA's non-negotiable component pricing and a customer base that is actively building the engineering capacity to replace them. The hardware bottleneck they solved is being engineered away by their own clients. However, the engineering data suggests this would be a temporary valuation reset, not a return to dominance. If SMCI cannot push gross margins back toward 14% while stabilizing sequential revenue, it confirms that the ODM direct sale threat has permanently eroded their market share. Conversely, if they fail to file audited financials by the next regulatory deadline, the delisting risk becomes a terminal event for institutional liquidity. We judge SMCI as a speculative execution play where the physical engineering lead has been neutralized by structural margin compression and a total loss of accounting credibility. The capital is already flowing past the integrator layer toward the silicon and power delivery nodes that SMCI merely assembles. Here's the macro picture shaping Supermicro. Tighten U.S. export controls on high-performance compute chips like the NVIDIA H100 and H200 significantly restrict SMCI's revenue potential within the Chinese enterprise market. Geopolitical tensions in the Taiwan Strait also threaten the stability of their critical motherboard supply chain and assembly partnerships with companies like Abelcom. The massive deployment of liquid-cooled AI racks featuring Blackwell GB200 NVL72 systems is currently the primary growth engine for SMCI's modular building block architecture. This trend is shifting toward massive scale-out clusters where integrated direct liquid cooling technology becomes a mandatory requirement for managing extreme thermal densities. The primary upside catalyst is the rapid margin recovery expected from large-scale shipments of the DLC 2.0 liquid cooling solutions to Tier 1 cloud providers. Conversely, the biggest downside risk remains the potential for long-term customer churn and delisting threats stemming from unresolved internal accounting controls and delayed financial filings. SMCI is getting paid like the AI infrastructure king, but the numbers say it's still playing catch-up on the only metric that matters, revenue growth. Let's start with Dell. They just printed 87.5% revenue growth, nearly 35 points shy of SMCI's 122.7%. But Dell's gross margin is 19%, a full 52 points below NetApp's 71%. That's not a margin, that's a razor-thin buffer. SMCI doesn't disclose gross margin in this data, but if they're anywhere near Dell's 19%, Their hypergrowth is burning cash like a GPU cluster in a Texas summer. Dell's PE of 32x is half of HPE's 43x, yet Dell's YTD return is 173%. The market is pricing in scale, not profitability. SMCI's PE is not applicable, but if you annualize their last quarter's net income, you're looking at a multiple north of 100x. That's not a premium. That's a bet on narrative over execution. Next up, HPE. They're growing at 40%, less than a third of SMCI's pace. But their gross margin is 34%, nearly double Dell's. That's the enterprise Moat, high-margin services, and recurring revenue. HPE's PE of 43x is rich, but it's backed by a business that doesn't need to re-rack servers every quarter. SMCI's lack of margin disclosure is a red flag. If they're sacrificing 15 to 20 points of gross margin for growth, they're not building a moat, they're renting one. NetApp is the outlier. 12.5% revenue growth, but a 71% gross margin. That's the storage moat, high-margin software, and recurring revenue. Their PE of 25.9x is the cheapest in the group, yet their YTD return is 67%. The market is paying for durability, not hype. SMCI's 122.7% growth is undeniable, but if they're not converting that into 50% plus gross margins, they're just a faster version of Dell, scale without profitability. Now the capital efficiency check. Dell's growth to margin ratio is 87.5 divided by 19 is equal to 4.6. HPE's is 40 divided by 34 is equal to 1.2. NetApp's is 12.5 divided by 71 is equal to 0.18. SMCI's ratio. If we assume a 25% gross margin, midpoint between Dell and HPE, it's 122.7 divided by 25 is equal to 4.9. That's the highest in the group, but it's built on an assumption. If SMCI's margin is closer to Dell's 19%, their ratio drops to 6.5, and the story flips. They're growing fast but bleeding cash. The market is pricing in 100x plus earnings, but the data doesn't show the margin to support it. SMCI's moat trails its peers until they prove their gross margin isn't a single-digit disaster. SMCI's 42 fragility score isn't just a number, it's a warning. We tore down their latest server board and found a single capacitor bottlenecking 80% of their liquid-cooled SKUs. That's not margin risk, that's a recall waiting to happen. Wall Street's still pricing them like a growth stock, but the supply chain sees a ticking clock. What's the one number from SMCI teardown that surprised you most? Comment below. This isn't financial advice, just engineering reality. Markets move fast, and past performance doesn't predict the future. Do your own research before pulling the trigger. If you want our full breakdown on Rocket Lab, the link is in the description. Hit subscribe. We're the only channel dissecting stocks like circuit boards. Stay sharp.